Now we can continue from where we left last time, and I remind you that our classes are ongoing. That is advanced financial reporting. So we are concluding a few things here and there, and therefore, if you are just joining us, you can see what you are doing today is conclusion of IAS 12, that is income taxes. Income taxes is what we are doing. We are concluding on income taxes. We are just joining us. So before we take this last example, because you have done numerous examples, remember we are having classes as well as revisions. We are doing the two beings simultaneously. Even though towards the start of the examinations, we will concentrate on revisions alone. For the time being, because of time, we are doing our classes as well as taking revisions simultaneously. Now somebody was asking for an extra example for IAS 12, that is income taxes, deferred taxes, and this student was specific. The student had requested May 2017, as it appears here. May 2017, question 4b, that is the calculation of net taxable timing difference. So, allow me, with your permission, that this will be the last question for the time being, as far as this semester is concerned, so that first we conclude the syllabus and then the revision questions I'll be doing after we complete the syllabus. So let me remind you what we have in the syllabus if you're just joining us for advanced financial reporting and analysis. We are doing chapter 1, accounting for assets and liabilities. So we have leasing, including sale and leaseback and dealers in leased assets. We've done leasing, that is IFRS 16, and IAS 17, that is operating leases and finance leases. We have done the theory and calculations. So IFRS 16 and IAS 17, we have covered that. The next, which you'll find in chapter 1, is deferred tax with group aspect, and that is IAS 12. That is what we are doing. We had finished that particular chapter, but a student had requested for an extra example, and that student had specified. We take together uh, May 2017 question 4b, and that is what I'm doing for that particular student. You can still have this discussion, and you can understand more about deferred taxes if you did not understand the previous questions. We have still done other questions in our YouTube. You can get them from the YouTube. So that is what we are going to do for today. So deferred taxes, we have concluded that. We finished that class, and today we are doing employee benefits. So tomorrow you can get the questions and answers in the YouTube. But so note that we have started employee benefits, but we have not uploaded that class in our YouTube. But within the next 24 hours or one day, you get employee benefits. That is IAS 19 in our YouTube. So basically what I'm saying is that in chapter 1, you're supposed to study leases, deferred tax, employee benefits, share-based payments, financial assets and financial liabilities, fair value measurement, and impairment of assets. So let's take this question. together, and then I think that should be enough for today. Now, let me remind you what we said. Maybe you did not understand the concept here. We said that when these kind of questions are tested, you are supposed to compare the carrying amount with the tax base. The difference between tax base and carrying amount gives us a temporary difference. Ordinarily, the carrying amount should equal to the tax base. So if the carrying amount is equal to the tax base, then there is no temporary difference. Carrying amount is the same as net book value. It is calculated by getting the cost of the asset you minus accumulated depreciation. It is usually found in the statement of financial position, and that is what mostly the examiner will give you. And then we have the tax base, which is the written down value, which is required for the purpose of tax. Therefore, if there is a disagreement between a business entity and the National Revenue Authority or the taxman, then there will be a difference now between your carrying amount in the books of accounts and the tax base as stated by the government or the taxman. And that will give rise to either a deferred tax asset or the deferred tax liability. So in our previous videos and in our previous classes, we discussed comprehensively concerning how deferred tax liability arises and how deferred tax asset arises. Now, if the carrying amount is more than the tax base, then it means that we are supposed to receive the difference in the future. Now, let me just explain that using an example, even though these things we have done previously. So, like for example, here you can see, because we're doing these kind of questions, you'll be required to have a column for items, and these items can only either be liabilities or assets. So if you take an asset like PP here, you have carrying amount or net book value of 14,000 but tax base of 2,800. It means that the government has stated it's the value of this PPE is 2,800. But in our books of accounts, we have used 14,000. So what does it mean? It means that the government has charged a lower figure. Ordinarily, you expect this figure to be equal to this so that there is no dispute concerning the amounts appearing in the books of accounts of the business entity and the amount that the government is using. But if that is not the case, you find, for example, here, the government or the taxman has used a lower figure in the sense that the carrying amount in the books of accounts of the business entity is more than the tax base, then it implies that, rather, the implication is that we may be required in the future to pay the difference. There's a difference here. If you compare 14,000 with 2,800, you find that there is a difference of 11,200. So in the future, the government can come back to us and tell us that we should pay this difference now to make the figure equal to what we earned in our books of accounts. So in that case, because we will be paying that particular figure, then it becomes a liability. So whenever your temporary difference is a positive, then you know that is a liability because you'll be required to pay in the future. If it is the other way around, that is, if the tax base is more than the carrying amount, it means that the government in the future may decide to refund the difference to us as a business. And in that case, that becomes an asset. Now, let's not spend too much time concerning explanations of what all this means. But before that, I've used CA to stand for carrying amount. Carrying amount is the same as net book value. TB is the tax base for the purpose of written down value. Remember, this written down value arises where we are calculating the capital allowance. And TD is the temporary difference. Temporary difference arises where the tax base is not the same as the carrying amount. So if you need more discussions about explanations, terms used in IAS 12, you just need to look at the very many discussions that we have been having the whole of this week, and you have most of them in our YouTube. Again, I will give you our number, our contacts, so that in case you need any help from our side, we can assist you. Now let's go straight away now to a question, because this question, the request was coming from a specific student that we do this question together. So we are doing it for that specific student. That is an advanced financial reporting, May 2017, question 4B, which is about income taxes. So allow me start. We read this question together, and then as we read the question, I'll be explaining the solution. Your solution is here. So as I read the question, I'll read the question as I show you the solution. So basically, what you'll be doing is that you'll be having a column for carrying amount or the net book values as provided for by the examiner, or the figures appearing in the books of accounts of the business entity, which are here, and then the tax basis. And then the difference here gives you the temporary differences. Now, I will be reading each item one by one as I explain the meaning of each one of them. Now, we are told that Munro Limited, a manufacturing company, provides for deferred income tax in accordance with IAS 12 income taxes. The following is an extract from the statement of financial position as at 30th April 2017. Allow me to present this information, to project this information to you, if you are able to see it. And I say that if it is possible, go to KASNEB app, and then you download most of these papers from 2015 up to the last sitting, because whenever we are doing revisions, and again you must have noticed that including our classes, all the examples that we use, they are from the past papers KASNEB. So I advise that you download all the past papers, you be with them, so that whenever we have a revision class or we are doing a question from the past papers, you have it with you so that you can follow easily. Now, let me project the question as it appears if you do not have that particular paper. So as I read, I will be reading and doing that question as we proceed. Now, I think that question is there. Monroe. Is that question legible? I'm looking for that question. I'm looking for that question. Is B. If you can see that question, Monroe Limited manufacturing company provides for deferred income tax in accordance with IAS 12 income taxes. The following is an extract from the statement of financial position is at 30th April 2017. If you are able to see that, information, now you realize something that you may realize there is that you are given assets. The assets like PP, you are given a certain figure, and then intangible assets, all that downwards. If you read downwards, you realize there are certain numbers given there. And then additional information number 1. So you'll be looking at additional information number 1, and those numbers given in additional information number 1 compare with what is in the statement of financial position. Now let me explain the first one, and then the rest will be easier for you because you have done a lot of examples. And you are told property, plant, and equipment. As it appears in the statement of financial position, then obviously that is the carrying amount. Now, if you look at the question from the board, you see PP is 14. Can you see that figure there? You can see property, plant and equipment, the last item. 14 is the first item there. That 14,000 is this figure here. 14,000 is there. That is a carrying amount. Now this carrying amount, we need to ask yourself, for the purpose of tax, what is the tax base on the PPE? This is what is in our books of accounts. But if you look at additional information number 1, you are told the tax basis of the assets are as follows. PPE 2800. Look at additional information number 1. Now, if you do not have a paper, this is what I'm talking about. Additional information number 1. You are told additional information number 1. The tax basis of the assets are as follows. Property, plant, and equipment. The tax basis. So you are given tax basis for PPE 28. As I have told you that this chapter or topic, you are comparing carrying amount with tax base. If there is a difference between carrying amount and tax base, then the difference is temporary difference. If carrying amount is more than the tax base, then this is a deferred tax liability. This is a deferred tax liability. Why is it a liability? The government charged a lower figure, so they can come back to us and tell us to pay this difference. There will be a money out moving from one business entity to the government. So this 11,200 is a deferred tax liability. So what you'll be doing to make your work easier and to be more faster, if it is for the purpose of the exam, compare mostly what is in the additional information. Because mostly the examiner will give you the tax basis in the additional information. So look at the items in the additional information, which most of the times comprises of the tax base, and then you compare them with what is in the statement of financial position. Like for example, in this question, might have not followed one another in that order, but I prefer that you look at additional information number 1. We have PPE, prepayments, interest-bearing loans, and financial assets or available for sale. So you can pick those 4 items and then you score those marks very fast before you go to the others which require a little bit of calculations. Now let me show you what I'm saying. Let me show you what I'm saying. I'm saying because already we have been given carrying amounts. If you look at additional information number 1, you can see the tax basis of the assets are as follows. Now these are tax bases. PPE 28, we have done that. Prepayments 1500. Interest bearing loans 17,000. Financial assets available for sale 14,000. So just pick those numbers the way they are, and then you take them to that column for tax basis, and then you compare with carrying amount. So in that case, you will have scored some 4 marks very straight away, depending on how the marking is done. So what I do is, I assume, not assuming it is a reality, my PPE is correct. So nobody can ask whether you are right or wrong there. We know 14,000 is the carrying amount as provided in the statement of financial position, and then 2,800 is the tax base, additional information number 1. So we are through with that. You can see 2,800 is less than 14,000, so that is a deductible or deferred, that is a deferred tax liability. I'll take number 2, prepayments. Let me take prepayments because prepayments have been given here. Prepayments, I'll go to prepayments. Additional information number 1, you can see prepayment there. The tax basis of the assets are as follows. Prepayments, item number 2, 1,500. And these prepayments, I have been given the carrying amount. Look at the prepayments there. Prepayments. Can you see prepayments there? Under the current assets. Under the current assets. Under the current assets. Prepayments. The figure is there. So I'll pick the prepayments. Let me work out on this. Prepayments. I'm given that 200 in the statement of financial position. Prepayments as a current asset, that 200 is in the statement of financial position that is given. Then additional information number 1, prepayments 1,500. So you are lessing that. That 200 minus 1,700, no, that 200 minus 1,500 is 1,700. So here, the tax base is less than. Is less than. So just like the first one there. So that is a deferred tax asset. This is a deferred tax asset. Is it an asset? No. Deferred tax liability. Deferred tax liability. Because the government has charged 1,500. Our books of accounts we have at 200. Therefore, we may be required to pay the difference in the future. So the difference of 1,700, deferred tax liability. So that is prepayments. You have done PP. The other item that I can see in the additional information number 1, so you have ruled that they can follow one another in your exam to make your work more easier. The other item that is given in additional information number 1 is interest-bearing loans. Interest-bearing loans. Interest-bearing loans, additional information number 1, item number 3, interest-bearing loans after prepayments is there, and you can also see it up there, interest-bearing loans under non-current liabilities, interest-bearing loans. So you can see that interest-bearing loans, the tax base is 17,000. this one here, interest bearing loans, 17,000 is there. Then carrying amount is 16,000. So 16,000 minus 17,000 is 1,000, which is a negative. So the government has charged a higher figure. So it means that in the future, the government may refund the extra back to us. So this becomes deferred tax asset. Deferred tax asset. The government may refund the extra. So you see, they can refund the extra 1,000 back to us. So that is interest bearing loans. So the last item, the tax base has been provided, is for financial assets or available for sale. I have financial assets here. This figure here, financial assets. You find it at 12,000 in the statement of financial position under the assets. 12,000 is here. And then additional information number one, financial assets or the available for sale is 14,000. 14,000. So 12,000 minus 14,000 is 2,000. So the government is charging a higher figure. Therefore, this is a deferred tax asset. Deferred tax asset, the government may refund the extra figure. So the financial assets, I think you can see the financial assets in your paper. If you don't have the paper, financial assets, the statement of financial position, financial assets is there. Also called available for sale. Financial assets. That financial assets at 12,000, you see it there. You are comparing with what is in the additional information. Financial assets or available for sale. The 14,000, the last item there. 14,000, the last item there. So the difference, you're just taking the carrying amount minus the tax base. So you get that. Now we are through with that. I encourage you to be comparing first. If in the additional information, mostly the additional information, they will give you the tax basis. Then you just take those items first. The carrying amounts or the net book values will be provided in the statement of financial position. So just compare them very fast, just subtracting. Then you put the answers under that column for temporal differences. Then anything else that may need explanations. So I can go to number two. Number two, additional question number two, I'm told inventories are stated at fair value less cost to sell, which is lower than the original cost due to a general provision for price decline of shillings 3.5. That is 3,500,000. Now this is my inventory. That is my inventory. Now listen to what you are being told. If you look at inventory in the statement of financial position, inventory is stated at 7,500. 7,500, but you are told inventories are stated at fair value less cost to sell, which is lower than the original cost due to a general provision for price decline of 3.5. So that 3.5 generally is the temporal difference, which is 3.5 is the temporal difference. So in other words, the temporal difference is what? 3.5 you plus 7.5, and that gives you a temporal difference of 11,000. So 7,500 minus 11,000, you get the same figure, 3.5. What does it mean? The government has charged a higher figure. So this becomes deferred tax asset. 11,000 by the government, 7,500 by the business entity, the government may refund the extra figure in the future to us. That is for inventory. You need projection for that. No problem. I can do that for you. I will do that for you. Inventory. Are you able to see inventory there? What I have done. Inventory is a current asset. So I take that inventory. Inventory, how much is that? 7,500. Inventory, 7,500. And then I look at additional information number 2. You can look at additional information number 2. That is what I'm saying. Maybe you can pause your video and you see what is there. I can read that number 2 for you, and I believe I have read it for you. That inventories are stated at fair value less cost to sell, which is lower than the original cost due to a general provision for price decline of shillings 3.5. So the 3.5 is the temporary difference. You can be able to get the 1100, that is this plus that. I'll move to additional information number 3. The intangible assets comprises of development cost, which is tax deductible when the amount is paid out. The cost of intangible assets was paid in the year 2014 and is presented net of amortization costs. Right, the intangible assets. Now I look at intangible assets and I realize that the figure is 4,000. This intangible cost there is 4,000. That is a carrying amount. You can read number 3. Read number 3. And now this one is not having any tax base. Read number 3. Intangible assets. You can see property, plant, and equipment. Then intangible assets is 4,000. Is the second item there. The second item, 4,000. But if you read number 3, it's giving you a certain story there. I don't know whether you'll be able to see that. Number 3. You can read number 3. The intangible assets. That one. You can pause and then you read number 3. You are being told that the intangible assets, this one here, you find the intangible assets as a carrying amount of 4,000, but we are told the intangible assets comprise of development cost, which is tax deductible when the amount is paid out. So here, there is no tax base. So 4,000 minus 0, you get 4,000. So that is that for tax base. Do we have any other? Of course we have. That is number 3. Number 4, goodwill and employee benefits are tax exempt. Now, if you are told certain items are tax exempt, what does it mean? There is no tax base. You have done taxation, and you are also doing it this time round, I think so. We still have taxation classes, so you can still get us for taxation classes, advanced, intermediate, ATD, and all that. So we have done a lot of taxation, including yourself there. So when I say an item is tax exempt, obviously it means there cannot be tax base, because tax base arises where the tax rate being applied by the revenue authority compared with that being used by the business entity differs. But in this case, if an item is tax exempt, then there cannot be there can be temporary difference. Items which are tax exempt cannot give rise to temporary difference. So that one simply means that goodwill and employee benefits. Goodwill and employee benefits which you can see in the statement of financial position. You can see goodwill at 6,000. So this goodwill, you not use it anywhere. You have your goodwill there. Will you be able to see that? Obviously. Item number 3, non-current assets. PPE, intangible assets, goodwill. Goodwill at 6,000. So that goodwill is a non-current asset, but we have been told it is what? Tax exempt. So it will not appear anywhere here. Because even if you put it here, to make no sense. To make no sense in our case. Because it can give rise to temporary difference. So goodwill and employee benefits. We still have employee benefits under current liabilities. Under current liabilities, down there, we have trade and other payables and employee benefits down there. So the employee benefits is given at shillings 2,000, but we are told goodwill and employee benefits are tax exempt. So if they are tax exempt, then they can give rise to temporary difference. Right. Number 5. Trade and other payables include provision for leave allowance of shillings 1.4 million, which is tax deductible on cash basis. So trade and other payables. I can see them and in the statement of financial position, trade and other payables as a current liability, and the figure is 8,000. Trade and other payables here. Trade and other payables, 8,000. That's a carrying amount. Trade and other payables, 8,000. They are current liabilities. Trade and other payables. Trade and other payables, you can see current liabilities at 8,000. Trade and other payables, 8,000. Trade and other payables, 8,000. You are told additional information number 5. Trade and other payables include provision for leave allowance of shillings 1.4 million, which is tax deductible on cash basis. You still need number 5. Just the way I've read it for you. Number 5. What I have read for you. Will you be able to see that? Number 5. Trade and other payables include provision for leave allowance of shillings 1.4 million, which is tax deductible on cash basis. Okay, that is it for that. Trade and other payables, 8,000. Trade and other payables is 8,000 as a carrying amount. However, additional information number 5 tells you that trade and other payables include provision for leave allowance of shillings 1.4 million, which is tax deductible on cash basis. So 1.4 million, it only means the temporary difference, 1,400,000. It means that. So what's the difference between this and this? Or in other words, this plus this minus that. 8,000 minus the 1.4 has been given. So that means the temporary difference is 1.4. So you should be able to get the tax base. But the most important thing was this, because by the end of the day, we need to sum up this column. So that is that. And you can see the government has charged lower figure. In the future, we may be required to pay the extra 1,400. So this is a deferred tax liability. Deferred tax liability. The last item remaining is trade receivables. Trade receivables. Now, trade receivables A trade receivable is a current asset and it is given at 66.50. The carrying amount. The carrying amount is 66.50. You need that. The carrying amount of 66.50. I'll bring it here to you. I'll bring it for you. 66.50. My camera has a problem, but I pray that it will work. Trade receivables is there, 66.50. You have current assets, inventories, then trade receivables, 66.50. In the statement of financial position, whatever is in the statement of financial position, you bring it as a carrying amount. So you have seen trade receivables, 66.50, but look at additional information number 6. Trade receivables are stated net of general allowance for bad debts at the rate of 5% of the gross receivables. The general allowance is not tax deductible until it becomes specific. In taxation, we normally say that all general provisions are disallowable, but specific provisions are allowable. So what are we saying here? We should make a provision for this general provision until they become specific. Now, what it means is that this 66.50, we have made a provision of 5%. 5%. You may be asking, where is 5% coming from? Additional information number 6. Additional information number 6. Trade receivables are stated net of general allowances for bad debts at the rate of 5% of the gross receivables. The general allowance is not tax deductible until it becomes specific. That's additional information number 6. So it means that this 66.50, already we have made a provision of 5%. So it is less by 5%. So it's like saying, if I say 66.50 is equals to 95%, because we have made a provision of 5. So it is less by 5%. I can ask myself, what about 5% will be what? Now, if you multiply that, if I take 66.50 times 5, I'll get 33,250 divided by 5, I get 66.50. I get 66.50, which is this. Again, you can say 66.50, like I have shown here, and check this working there. 66.50 is equals to 95. Because it's 66.50, you have made a provision of 5%. So it is less by 5. So 66.50 is equals to 95. What about 100? So you take 66.50 times 100, you divide by 95. You divide by 95, which is 7,000. 7,000. So you see, the carrying amount, we made a provision of 5%. But the taxman did not consider this 5% because it is a general provision. So they say we will have a 7,000, not 66.50. So we earned the 350 here in the books of the taxman or the tax base. They will use 7,000, and therefore there is a difference of 350. So it's a question of If in the books of the business entity, the trade receivables is 6650 because there is a provision, general provision, but a general provision is a disallowable. Is disallowable. What is allowable for the purpose of tax is a specific provision. So they entered bank the 5% here to get 7,000. And now the temporary difference is 6650 minus 7,000, which is 350. Okay, let me see something here. If I take 6650 and multiply by 5 and I divide by 95. So it's like saying 6650 is equals to 95. What about 5? I can still have it that way. What about 5? Will it give me 350? 6650 is equals to 95. Because this one they have deducted 5. 6650 is equals to 95. That is 100 minus 5. What about 5? That 5 will be what? You take 6650 times 5, 6650, you multiply by 5, you get that 33 to 50, then I divide by 5. I divide by 5, you are getting 6650. So 6650. I think we've done that one before. I think we're okay with that. Uh, so after that, I think we are through with each and every item in the question. We are through with each and every item in the question. Number 7, you are told the building which is included in property, plant and equipment was revalued during the year. The increase in value of shillings 3 million does not affect the tax base. So the revaluation is not affecting the tax base. It will only affect the deferred tax. This revaluation of 3 million. So that is not affecting. Additional information number 7 does not affect the tax base. What do you have there? Number 7? You have number 7. Number 7. Number 7 is there. The building, which is included in property, plant and equipment, was revalued during the year. The increase in value of shillings 3 million does not affect the tax base. So you take 3 million times 30%. You take it on the credit side of the deferred tax account. Number 8, the tax base of other items is equal to their carrying amount. Then the tax rate applicable is 30%. Required deferred tax balance, and number 2, deferred income tax account. So I think we are through with all the calculations. So finally what you do is that you add now all these figures downwards. When there is a negative, you use a negative. When there is a positive, you use a positive. So finally, you get net taxable timing difference. This one. Net taxable timing difference. Now in our case here, this number is a positive. Therefore, that becomes what? Deferred tax liability. Deferred tax liability. The total you earned downwards. Where there is a positive, use a positive. Where there is a negative, you use a negative. You sum all of them. You sum all of them, and your answer will be here. It is a positive 12,450. Deferred tax liability. Deferred tax liability. Then you get 30% of that. That percent of that. You multiply this one by that percent. That is your deferred tax liability for that particular year. Then deferred tax account, how you prepare it is that you check whether in the statement of financial position there is opening balance. So we are given deferred income tax. 1st May 2016, at 1200 in the statement of financial position where you have non-current liabilities. You have non-current, where you have non-current liabilities, you can see non-current liabilities, deferred income tax into brackets, 1st May 2016. Should be able to see that. And the figure is 1200. So that is our opening balance. And you know that liabilities have a credit balance. So you bring it here. Balance carried down or balance brought forward 1200. Now, additional information number 7, we were told the building, which is included in PPE, was revalued during the year. The increase in value of shilling 3 million does not affect the tax base. So this revaluation of 3 million does not affect the tax base here. So it only affects the deferred tax. So you just take the 3 million times that percent, we get 900. Then finally, you take the balance carried down. So we are given the opening balance in the statement of financial position. Then this revaluation, that percent of 3 million is 900,000. Then balance carried down is now this figure you have calculated there. 3735 balance carried down. So the balancing figure is what goes to the income statement for that particular year is 1695. So that is the end of that discussion for today. That is the end of that discussion for today. Unless you have any question. If you have any question. So I think that's a good question. It's a good illustration. Even though we have done a lot of discussions, a lot of examples, a lot of stuff this week concerning chapter 1. We are almost finalizing chapter 1. So make sure you be part of us so that we may move together. So you can subscribe to our YouTube, that is Fatima Institute. You can like our video, subscribe, you like our video, you make a comment so that we can move together as we discuss financial reporting, advanced financial reporting, and also other subjects. So I think we don't need to repeat too much about IAS 12, income taxes, deferred taxes, but I've told you that make sure you know some theories concerning deferred taxes, IAS 12. The examiner may require you to explain meaning of some terms used in IAS 12, like temporal differences, as we discussed last lessons. So that is the answer for that particular question. I think you are certified with that. So you just need a column for all the items. I told you these items will only be liabilities and assets. This column is for carrying amount or the net book value. You know how to calculate net book value. Cost of the asset minus accumulated depreciation. However, most of the times the examiner will give you the carrying amounts. The statement of financial position, which the examiner gives you, is where you will be getting these carrying amounts. If the amount is stated at cost in the statement of financial position, you can use that. Most probably, you find in the additional information you are given fair value or market value. So you use the fair value or the market value. We don't use the cost of that particular asset because we are interested with the net book value. That's the important point. Now, once you have this column for carrying amounts or the net book values, the other thing is to have a tax base. The tax base, mostly, you'll be given in the additional information, you'll be told the tax base for certain items are as follows. So yours is only to compare the figures given in the additional information with what is in the statement of financial position. Like for example, the PPE in this question, the carrying amount was 14,000. Additional information number one, they are telling you the tax base is 2,800. You just pick the figures directly and then you minus. I've told you the effect of carrying amount being more than or less than the tax base. What's the meaning of this difference there? So it can either be deferred tax asset or deferred tax liability. So as you get that, all these differences, some will be plus, others will be minus. You sum all of them, you add all of them, and then you get the final answer here. If the final answer is a positive, then that is a deferred tax asset, deferred tax liability. If it is a positive, the final figure is a positive, that is a deferred tax liability. The final figure is a negative, that's a deferred tax asset. Then multiply by the tax rate, and then you prepare deferred tax account that way. So that is the end of that. I think we move forward now. We are doing another different thing from IAS 12. So we can meet next time as the discussion continues. For any assistance, for any help, plus 254 727 87 10 93. That's the number. For those who are following from other countries, start with plus 254. This is a code for Kenya. That is a code for Kenya or Kenya. Some call it Kenya, but it is Kenya. We call it Kenya, but some of you call it Kenya. In other countries, that's our code, Kenya or Kenya. If you are within Kenya, it's just 0727 87 10 93. For revision materials like CPA books, ATD books, CIFA books, and anything else to do with management, you just call that number. We will assist you as much as we can. I think there is nothing else concerning IAS 12, that is income taxes. So we'll proceed now with the employee benefits, and that is what we are doing. So you can just understand what you have done here as the discussion continues. So that's enough for that. So let's meet later.